Good day. This is a presentation on break-even analysis. Break-even analysis is a cost and management accounting concept that tries to deduce the level of sales in unit and naira when profit equals zero. In other words, break-even analysis is a concept that tries to explain the level of sales that is required for a company to achieve break even. And break even is a point where the company is neither making profit or loss. In other words, the company's profit is equals to zero. So break even analysis helps to determine the level of sales both in unit and in naira that is required to attain this point. Now there are 5 assumptions of break even analysis. The first one is that all the costs are classified into 2 categories, fixed and variable. The second is there are no closing and opening stock. In other words, everything produced for that period was sold. Number 3, at break-even point, the fixed cost is equal to the contribution. The fixed cost is equal to contribution. Number 4, variable costs change with the activity level. And number 5, fixed cost remains unchanged over time. So these are the 5 assumptions that this break-even analysis is dependent on. So we want to quickly explain some terms before we go fully into how it works. Fixed costs. Fixed costs are costs that remain constant over a period of time. They remain unchanged. For example, rent. Your rent remains the same for a period of time until it is increased, but it remains constant for a number of years. Variable cost, the second term, the cost that change with the level of activities. So variable cost is dependent on activities, is dependent on production, is dependent on the level of sales or the level of production. Where there is no sale or production, variable cost equals to zero. Also, variable cost is incurred for the day-to-day operation of business. Is incurred for the day-to-day. So while variable cost per unit is always constant, the variable cost per fixed cost per unit varies. Now, the reason why variable cost per unit is constant is because there is a particular amount that is incurred for 1 unit of production. However, the fixed cost is constant. And so to determine the fixed cost per unit, you need to divide by the level of production or the quantity, the volume of production, which varies over time. For example, if the fixed cost is 100,000, and in this particular year, 10,000 units were produced, what that means is that the fixed cost per unit is 10 naira. But if in the next year or in the next period, 20,000 units were produced, the fixed cost changes to 5 naira per unit. That is why the fixed cost varies depending on the level of production, while the fixed cost per unit is constant and is applied on the level of production. And the third term there is contribution. Contribution is the amount obtained by deducting the fixed variable cost from the total sales. It is that amount available to recover our fixed costs or that has already been incurred to arrive at a profit. So contribution is determined by deducting the variable cost from total sales. The variable cost is the total cost incurred for production, depending on the level of goods or the volume of goods produced. And remember, our assumption says that the production is equals to sales. So depending on the number of goods produced, for example, 10,000 goods, 12,000 units were produced at 5 naira. That gives us 50 naira variable cost. And they were sold at 8 naira per unit. That gives us 80,000 naira total sales. So 80,000 minus 50,000 gives us a contribution of 30,000. Now, this same contribution is what is compared with our fixed cost to determine if the business made a profit or a loss. So the contribution, in other words, contribution minus fixed cost. If contribution is greater than fixed cost, then the business had made a profit. But if contribution is less than the fixed cost, then the business has made a loss. Quickly, let's look at the formulas to determine the break-even point. So in calculating the break-even point in units, we say fixed cost divided by the contribution margin per unit. And as already explained, contribution margin per unit is the sales per unit minus the variable cost per unit. So the total fixed cost divided by the contribution per unit gives us the break-even point in units. And when we want to determine the break-even point in Naira, we do that by dividing fixed cost by the contribution margin ratio. And the contribution margin ratio is the same thing as the contribution margin per unit over the sales per unit. So contribution margin ratio is the same thing as contribution margin per unit divided by sales per unit. So when we do that calculation on the fixed cost, it gives us the value of break-even in Naira. Now, the level of sales to result in a targeted profit. So if we want to determine how much sales should be made in order to arrive at a particular amount of profit, we achieve that by adding that particular target profit to our fixed cost and dividing by the contribution per unit. And when we want to determine the level of sales to achieve a particular level, a particular target profit in Naira, we still add that target profit to the fixed cost and divide by the contribution margin ratio. Now, when we want to determine now these two targeted profit are profit before tax. Profit before tax. But when we want to determine the level of sales to achieve a targeted profit after tax, what we do is we first of all subtract the tax rate from 1. For example, the tax rate is 30% in Nigeria. So when we take out 30% from 1, it gives us 70% or 0.7. And so we divide the target profit. For example, we want to make a profit of 10,000 naira. So we divide 10,000 by 0.7. 10,000 by 0.7. Now the answer that gives to us, it will be in decimal places, will be added to fixed cost. Added to fixed cost. Remember, fixed cost is constant, doesn't change. It will be added to fixed cost, and the answer will be divided by the contribution per unit. That gives us the level of sales we require to achieve a targeted profit after tax in units. But when we want to achieve this in Naira, the only difference is that after we must have divided the tax, and then divided the targeted profit, added to the fixed cost, we will now be dividing by the contribution margin ratio as against the contribution per unit. So contribution per unit is used to determine level of sales in units. Contribution margin ratio is used to determine the level of sales in naira. Now, the margin of safety in units is gotten by the budgeted unit minus the break-even unit, the margin of safety. And the margin of safety in naira is gotten by subtracting budgeted sales value from the break-even point in naira. The margin of distress in unit is gotten by subtracting break-even unit from subtracting minimum unit from break-even unit. Minimum unit from break-even unit. In other words, margin of distress in unit is equal to break-even unit minus minimum unit. And the margin of distress in naira is break-even in naira minus minimum sales value. Now, the application of these formulas will help any business determine the level of sales required to break even, level of sales to make a targeted profit, both in unit and in naira, targeted profit before sales, targeted profit after sales. The application of these formulas will help the business to determine that and to work towards achieving it so that the business doesn't make a loss. Rather, the business stays afloat making profit because you already ascertained the break-even unit, the break-even in value in naira, and worked towards it. Thank you.